But let me now welcome on board Vikas Gupta, MD Operations at PG Electroplast, to talk about how their quarterly performance has been. Vikas, great to have you on ET now. Starting off firstly, despite strong top-line growth, the EBITDA margin has declined for you. What led to that, and what specific levers will help you achieve the 8% operating margin target that you had for the fiscal end?
Please understand, right now the commodity inflation is very high, and we have been able to pass on some part of that uh, BOM cost increase to our clients, and some is still under discussion. We feel that we will be able to pass on the complete impact of the increase in the cost of the bill of material to our clients in the coming quarters, and we are already in discussion with them. So we are hopeful for maintaining that 8% margin in the coming quarters.
Can you also give us a sense of, you expect a growth of nearly 20% plus ahead of industry growth. What structural advantages gives you that confidence that you can consistently outperform the industry?
So we are already working with the clients, and it is based on the product pipeline that we have and the interactions that we have with our customers. We are confident that we will be able to grow at an industry-leading growth level, and I think the teams are working on that. We are already increasing the wallet share with the existing clients. We have already onboarded quite few new clients also in the past quarter. And so based on that working, we are confident that we should be able to grow at a decent pace going forward.
Right. I want to talk about the major highlights of the quarter gone by and what, according to you, was the growth driver.
So it was kind of a landmark quarter for PG Electroplast. We did cross the revenue of 2,000 crores in a single quarter. That was a first for this company. Then we achieved our highest ever sales in air conditioners and in wash machines in this quarter. So this quarter has been quite remarkable in the terms of performance in our these two broad categories. And overall revenue also grew and crossed 2,000 crores, which kind of a landmark for us.
Because you're going to see several new facilities coming on stream this year. How quickly you expect these plants to reach optimal utilization, and when can we see a meaningful revenue contribution?
So we are coming with a brand new greenfield facility for refrigerators in City City near Chennai. And we expect that we should be able to start the commercial productions in the Q4 of FY27. We are hoping that it should start contributing meaningfully to our revenue and our bottom line for FY28. And we are already in touch with the clients. We already have some soft commitments. So we are very bullish on that refrigerator project. We have also come up with a new, I would say, best-in-class manufacturing plant for the washing machines in Greater Noida, where we have further increased our capacities. That has already started the production, and we are hopeful that we should be able to have a adequate loading and in the coming quarters. We are already experiencing a robust growth in our washing machine business. So we are very confident that we should be able to engage that capacity very soon. We have also come up with a new plastic molding and tool room plant in the Salarpur in state of Rajasthan. That is also started the commercial production. So that should also start contributing from the next quarter. And FY28 should be a better year for that plant. So hopefully we feel that these three plants will start contributing in an effective way in the FY28.
Right. But tell me, once the compressor business scales up, what should investors expect in terms of profitability versus your existing EMS business? Could it structurally improve your consolidated margins?
So compressor is again a landmark project for us that we initiated 2-3 quarters back. And we are hopeful that we should be able to start the production in our compressor facility by, again, Q4 of FY27. We are seeing a very keen interest from some of the clients, and we are hopeful that we should be able to engage this capacity very rapidly. We are coming with a 2 million capacity right now, and the land and building that we have created is capable of handling a capacity of almost 7 to 8 million. So in the phase one, we are putting up 2 million capacity, and it should, like, most of that, I would say the major part of that 2 million output will be used for our captive consumption. So it may not add to the revenue side, but definitely will be margin accretive. It is very difficult to give me some kind of a accurate number to that, how much impact on that margin it will have. But our teams are working on that, and we are hopeful that it should definitely help us in improving our margins in air conditioner business.
Because as you diversify beyond room ACs, how do you see the revenue mix evolving over the next 2 to 3 years? Which businesses have the biggest potential to become meaningful growth engines for you?
So currently, the air conditioners contribute almost around 60 to 65% of our revenue. And I think going forward, AC will still remain a significant part of the revenue for our company. We are also we have got into refrigerators, and we are growing our business in electronics division. We are growing our business in washing machine business. So we are anticipating that we should be able to bring down the dependence on air conditioners as a revenue stream in our company from 65%, 60% to 50% in next 2 to 3 years.
Right. And now that the business has returned to a net cash positive position and the major Capex cycle is now nearing completion, how should investors think about free cash flow generation and, of course, your return ratios as well over the medium term?
Our teams are working on this aspect only. Now, this year also, current year, we have a Capex guidance of almost around 400 crores internally. We are working on that. Largely, that Capex will go into the completion of ongoing projects of our compressor and refrigerators. Beyond that, we do not see a major Capex cycle for the FY28. But definitely, as the revenue improves, as the margin improves, the cash flow position should improve. We do not have the accurate number right now, but the teams are working on that to create the adequate free cash flows to fund the future expansions.
Guys, thank you very much for giving us this perspective after the earnings. Thanks for joining us today.